Welcome to the Deep Dive, where we take a stack of information, in this case, the latest annual report and other sources for Berkshire Hathaway, and unpack it to find the most important nuggets of knowledge and insight just for you.
It's quite a stack this time.
It definitely is. Today, we're diving deep into Berkshire's 2024 Form 10-K and related documents. Our mission: to cut through the financial jargon and corporate detail to really understand what happened at this unique company last year.
And figure out what drives its performance, how it's thinking about the future.
Exactly. Think of this as your shortcut to being well-informed about one of the world's most fascinating and frankly complex businesses. It's not just about the numbers. It's about the underlying businesses and, the philosophy. Okay, let's unpack this stack of sources and see what we can find.
So right at the start, the report reminds us what Berkshire Hathaway actually is. It's not your typical operating company. It's primarily a holding company.
Right, a holding company.
It owns a vast array of subsidiaries engaged in incredibly diverse activities.
And when they say diverse, they really mean it. The report calls out the biggies like insurance, freight rail with BNSF, and the utility and energy businesses.
Yeah, those are the pillars.
But then there's this massive collection of others: manufacturing, services, retailing. How do you even manage something so spread out?
Well, that's one of Berkshire's defining characteristics, isn't it? It operates on an unusually decentralized basis.
Decentralized.
Yeah, few centralized functions mean a lot of autonomy for the actual businesses.
So the folks at headquarters aren't getting bogged down in the daily operations of, like, a candy company or a brick manufacturer.
Exactly. Senior management, the report highlights, focuses on the truly critical decisions. Major capital allocation, deciding where the money goes.
Okay.
Significant investment decisions, and selecting the CEOs who run those operating businesses. They also set the overall governance framework.
So it's more strategic oversight, not operational micromanagement. I recall a principal mentioned in the sources about how they discuss the performance of these subsidiaries.
Yeah.
Something about praise and criticism.
Yes, it's advice given years ago. Praised by name, criticized by category. It reflects that decentralized approach, celebrating individual successes while addressing issues sort of systemically, rather than singling out specific business units for criticism in the public report. It's a fascinating insight into the culture, really.
It really is. Okay, let's apply that maybe. Let's start with the biggest piece of the puzzle: insurance. The report calls it the core business.
And for good reason. This is where the unique financial model comes in, the one that generates what everyone talks about: float.
Okay, let's unpack that term float. What is float and why is it so important here?
Simply put, insurance companies collect premiums upfront
Right.
before they pay claims. That money they hold in between, that's the float.
Yeah.
It's essentially interest-free money that Berkshire can invest until claims eventually need to be paid. A huge advantage.
And the sources list the key engines generating this float. You've got Geico in private auto.
The big one everyone knows. Yeah.
All the large commercial insurers like BHHC and BHSI, the specialty groups from Allegheny like RSUI and Cap Specialty, and others serving small businesses. Quite a range.
And Geico had a standout year in 2024. The report notes a major increase in earnings.
Right.
This didn't just happen. It was the result of deliberate actions by management, specifically Todd Combs, who's been reshaping the business, increasing efficiency, updating underwriting practices.
So the earnings gain reflected things like charting higher average premiums and seeing fewer claims happen. That's lower frequency in insurance talk.
Correct. But they still had challenges. Severity increased, meaning each claim cost more on average.
Okay.
Plus, there were catastrophe losses, and prior year estimates still impacted the results a bit, tweaking previous assumptions.
Got it. And moving into the more complex end of insurance, the Berkshire Hathaway Reinsurance Group, BHRG, global business, huge range of coverages.
Yeah, and the report highlights a specific pre-tax underwriting charge of $490 million in 2024 related to a settlement. These things top up.
And reinsurance, particularly that retroactive reinsurance, insuring against losses that have already happened that can lead to liabilities stretching out for decades, right?
Absolutely. The sources note significant estimated liabilities here. $32.4 billion in gross unpaid losses at the end of 2024. And it's subject to considerable estimation error.
Because you're guessing how bad old problems will be years down the line.
Precisely. But what's fascinating here, and a core advantage for Berkshire, is their financial strength. They can handle massive, extreme losses without buckling or needing to rely heavily on other reinsurers.
That makes sense.
This ability frees up significant sums from their insurance operations to float for investment. The report points out that over 2 decades, they've generated $32 billion in after-tax underwriting profit and seen float grow dramatically, from $46 billion to a massive $171 billion.
Wow, $171 billion in float. That's the power of this core business then.
Absolutely, it fuels the whole enterprise.
Okay, shifting gears completely. Let's talk about Burlington Northern Santa Fe, or BNSF, one of the largest railroads in North America.
Right. A vital piece of infrastructure moving a really diverse mix of goods, raw materials, manufactured products, agricultural outputs across a huge network.
Huge network, yeah.
Yeah.
And the regulatory environment for railroads is complex, isn't it? Multiple agencies involved.
Very complex. STB, DOT, OSHA, EPA. And environmental matters continue to be a source of increased costs and potential liabilities. It's just part of running a railroad today.
And they face competition, primarily from Union Pacific, but also trucks, other transport methods. It's a core business, but definitely capital intensive with significant operational challenges.
No doubt about it. Essential but complex.
Next up, Berkshire Hathaway Energy, or BHE, another big one.
Yep, a diversified portfolio mainly in the energy industry.
Utilities and pipelines, primarily. They serve roughly 5.3 million customers in the U.S. through regulated utilities like PacifiCorp, MidAmerican Energy, NV Energy.
Big service territories. And they own substantial power generation capacity, over 31,000 megawatts, with demand naturally fluctuating with seasons, summer electric, winter gas.
And like the railroad, BHE is heavily regulated. Federal, state commissions approving rates, usually based on cost of service plus a return.
Right. That regulatory landscape is always shifting, which brings us to a challenge highlighted in the report.
The EPA rules.
Exactly. New rules finalized in 2024 aimed at greenhouse gas emissions from the power sector. Scheduled to kick in around 2030, they'll require utilities to use lower-emitting fuels or capture carbon. Big changes.
But the report notes this rule is being challenged.
Yeah.
And might be reevaluated.
Yeah, underscoring the uncertainty utilities face as regulations push towards decarbonization. It's a moving target.
And BHE has a very specific and frankly quite concerning challenge. Mentioned the wildfire situation with PacifiCorp.
Yes, that's very serious. The report confirms probable losses from past fires in 2020 and 2022.
Okay.
And warns of the potential for significant additional losses beyond what's currently set aside, with ongoing legal actions. This is a major risk factor for that segment.
Definitely sounds like it. Okay, now for the biggest, most sprawling group, manufacturing, service, and retailing. It's almost overwhelming how much is in here.
It really is. This isn't one thing. It's dozens of different businesses, kind of a catch-all category.
It covers everything from precision components for aerospace, precision cast parts, to chemicals at Lubrizol, metal cutting tools from IMC.
You've got building products like Clayton Homes, which makes manufactured and site-built homes.
Big player there.
Shaw in flooring, Johns Manville in insulation. Lots of construction exposure.
And consumer products like Forest River, making RVs, buses, boats. I remember reading that quick story about the founder, Pete Legal, described as a natural businessman.
Yeah, classic Berkshire acquisition story. Then you have Fruit of the Loom and apparel, Rich Line and jewelry. It just goes on.
Services are in here too. Pilot Travel Centers, where Berkshire bought the remaining piece early in 2024, so it's fully owned now.
Right, big network there. Plus flight safety for aviation training, NetJets for private aviation.
And home services, the real estate brokerage. That's one's facing a major legal challenge regarding commissions, right? Leading to a $250 million settlement agreement mentioned in April 2024.
Yes, that's another significant legal issue they're managing within that diverse group.
So looking at the trends across this incredibly diverse group in 2024, what did we see?
Well, manufacturing earnings actually increased, partly driven by some industrial businesses benefiting from better margins as raw material costs came down, maybe some improved efficiency.
Okay, so some strength there.
But service and retailing earnings decreased, impacted by softer performance at several businesses in those sectors. A bit of a mixed bag.
So despite some bright spots, overall earnings for this huge combined segment were down slightly, about 2.2% in 2024 compared to 2023.
That's right. It really highlights how varied the performance is under this one massive umbrella. Performance isn't uniform at all.
Okay, let's zoom out then and look at the key financial highlights for the whole company. The big picture.
Right, the consolidated view.
The big number everyone looks at first is earnings. Operating earnings saw a significant jump. $47.4 billion in 2024 way up from $37.4 billion in 2023.
A really strong year for the underlying business's profitability. But, and this is crucial, reported net earnings include investment gains or losses from their stock portfolio.
Ah, yes, the stock swings.
And those are incredibly volatile.
I saw those numbers, a $52.8 billion gain in 2024, a $74.9 billion gain in 2023, but a huge $67.6 billion loss in 2022. It's all over the place.
Exactly. And the report is very clear about this, as it always is. These fluctuations are generally meaningless when trying to understand the operational performance of Berkshire's businesses over any short period.
Right. They cause massive swings in the bottom line net income figure, but don't really reflect how well, say, the railroad ran or how profitable the jewelry stores were day to day.
Precisely. So key insight. Focus on operating earnings to see how the actual businesses did.
Okay, so what drove that impressive $10 billion increase in operating earnings?
Several factors contributed. A major piece was the increase in investment income.
From?
Largely because Berkshire held more treasury bills, and the yields on those short-term treasuries were higher. So that big cash pile wasn't just sitting there idly, it was earning more.
Ah, okay, so that growing cash pool actually contributed meaningfully to operating earnings through investment income. Interesting.
Yes, and of course, the major increase in insurance earnings, led by GEICO's turnaround, was obviously a huge driver, as we discussed earlier.
That makes sense, given how big insurance is.
Absolutely significant. Plus, you had manufacturing earnings increasing overall, even while this service retailing group softened slightly.
And utilities.
In the utility segment, BHE, net earnings rose too. This was due to higher electric utility margins from rate adjustments and volumes, plus some tax benefits from wind energy credits.
But offset partly by...
Partly offset by expenses like wildfire mitigation efforts, that's a real cost, and higher interest costs because they had increased borrowings.
Okay, so a combination of a very strong insurance rebound, a nice tailwind from cash holdings earning more, and sort of mixed but generally positive performance across the other major segments.
That sums it up pretty well. A strong operational year overall.
Now let's look at the balance sheet where all this capital sits. What stands out there?
Well, the number that just jumps off the page is the cash, cash equivalents, and U.S. Treasury bills.
Ballooned, didn't it?
Ballooned is the right word. From around $122 billion at the end of 2023 to a staggering $212.6 billion by the close of 2024.
Whoa, that's a massive increase. Over $200 billion in cash and equivalents.
It reflects the huge cash generated by those profitable operating businesses and investment activities, clearly outpacing the amounts they deployed through investments or acquisitions during the year.
Meanwhile, the marketable equity securities, their stock portfolio, actually decreased in value from about $346 billion down to $263 billion.
Right. Market fluctuations play a big role there, obviously. And the report highlights a key point here. Concentration. Yeah, around 71% of the value in that entire stock portfolio is in just 5 companies.
Only 5 companies make up almost 3/4 of the stock holdings.
That's right. That concentration makes their overall asset value highly sensitive to the performance of a very small number of stocks. It's a risk factor they explicitly call out.
Makes sense. And fixed maturity securities, bonds, were a much smaller slice at just over $15 billion.
Yeah, relatively small compared to the equities and cash. On the liability side, there is substantial debt throughout the company.
But it's at the subsidiary level.
Crucially, yes, it's primarily at the subsidiary level, like BNSF's $23.5 billion or BHE's $56.4 billion. Berkshire Hathaway, as the parent company, does not guarantee the debt of BNSF, BHE, or their subsidiaries.
That's a really important structural point. It enhances the parent company's financial strength, keeps it separate.
Definitely. And we mentioned those significant insurance liabilities from unpaid losses, like the retroactive reinsurance. That $32.4 billion figure is a large liability line item on the balance sheet, and as we said, subject to considerable estimation uncertainty over time.
Okay, so with all this cash generation and this fortress balance sheet, how does Berkshire actually create value for you, their shareholders, especially since they famously don't pay a regular dividend?
Right. The report states unequivocally that Berkshire hasn't declared a cash dividend since 1967. It's just not how they operate.
So their method is different. It's common stock repurchases or buybacks.
Exactly. They have a standing program that allows them to repurchase shares, but only when the price is below Berkshire's intrinsic value, their own conservative estimate of what the business is truly worth.
So they're price sensitive about it.
Very. There's no set target amount for buybacks, but they maintain a strict rule. They won't let repurchases drop their consolidated cash, cash equivalents, and treasury bills below a $30 billion threshold.
$30 billion floor.
Yeah, it underscores their absolute priority of maintaining redundant liquidity, keeping a massive cash buffer on hand no matter what. Financial strength above all.
And did they actually buy back stock in 2024?
They did. The report shows Berkshire deployed $2.9 billion to repurchase common stock during the year.
Okay, so that's the mechanism. Return capital to shareholders via buybacks, but only when the stock seems attractively priced relative to intrinsic value, and always while keeping that huge cash safety net intact.
That's the Berkshire way for shareholder returns.
Looking ahead now, the report acknowledges the inherent uncertainty, macroeconomic shifts, geopolitical events, all the usual unknowns. But it also lays out some key risks and challenges specific to Berkshire.
Yeah, they're pretty candid about those. One prominent risk is the dependence on a few key individuals for major investment and capital allocation decisions.
The leaders.
Right. The report mentions Warren Buffett, Greg Abel, and Ajit Jain by their roles, and notes the succession plan is in place for the CEO role. But still, their judgment is absolutely central to the strategy.
And that concentration in the equity portfolio we mentioned. That's highlighted as a risk too, right?
Definitely. It makes them subject to significant loss in value if those specific stocks underperform. It ties back directly to that investment volatility we saw in the earnings numbers earlier.
Makes sense. What else?
Regulatory changes are a constant factor across all their businesses, whether it's finance, environmental rules like the EPA's affecting BHE, or tax policy changes. The report points out this adds to compliance costs and operational complexity.
And cybersecurity is called out too. Which seems unavoidable these days.
Absolutely. With operations spanning so many industries, reliance on technology is huge, and sophisticated attacks are a constant threat with potential for significant disruption, loss of assets or information, reputational damage. It's a big one.
And specific litigation risks are noted, particularly the ongoing situation with Pacificor's wildfires.
Still unfolding.
And the Home Services settlement regarding real estate commissions. These are real material challenges they're currently navigating.
Yep, not abstract risks, but current issues.
But despite these risks, the report reinforces those core principles that guide the future, doesn't it?
It does. Continuing to deploy a substantial majority of their capital into equities, primarily American businesses, maintaining that fundamental preference for owning good businesses over just holding cash.
Even though the cash pile is substantial right now?
Yes. Even with $200 billion plus, and absolutely prioritizing maintaining financial strength and redundant liquidity, that $30 billion cash minimum is clearly non-negotiable.
Those principles seem deeply ingrained.
They define the company.
So what does all of this mean for you, the listener, perhaps a current or potential investor in Berkshire Hathaway? How do we wrap this up?
Well, it means owning a piece of a truly unique, decentralized empire built on a powerful insurance engine that generates substantial cash. That's the foundation.
It means exposure to an incredibly diverse portfolio of industries, railroads, utilities, manufacturing, retail, you name it, each with its own dynamics, competitive landscape, regulatory hurdles.
And specific challenges, like the energy transition impacting BHE or those legal liabilities we discussed.
And it means a company where capital allocation is really the core strategic function, relying heavily on the judgment of its top leaders.
Right. And returning value not through dividends, but through those carefully considered share buybacks, guided by intrinsic value and that unwavering commitment to maintaining vast financial strength.
Okay, so here's where it gets really interesting, the final thought for you to chew on. Considering the immense size of that cash pile that grew even larger in 2024.
That $212 billion.
The inherent volatility and concentration in the marketable investment portfolio, and the very real ongoing challenges highlighted in key operating segments like the wildfire risks at Pacificor or the regulatory pressures on BHE. What single factor do you think will have the most significant impact on Berkshire's performance and trajectory over the next few years?
Is it successfully finding ways to deploy that massive cash hoard in large value-adding acquisitions or investments?
Or is it the performance of that handful of heavily concentrated stock holdings? Will Apple or the others continue to drive value?
Or perhaps it's successfully navigating and mitigating those specific operational and legal headwinds in the core businesses, like the utility and real estate issues.
What's the biggest lever or the biggest risk? Something to chew on as you think about the complexity and future of this extraordinary company.
A lot to consider there.
That's our deep dive into the Berkshire Hathaway 2024 10K. We hope this helps you feel more well-informed about the key insights and dynamics at play.